Okay, today's Cardinal Lesson, 2026 federal income tax, brackets and rates. Sounds like great cocktail party conversation. I mean, it's just really interesting. My wife is always like, he's really interested in this stuff. And most of you aren't. But the 2026 rates are out, the brackets thing, and I just want to push it to Tom. So why are we talking about these today?
Yeah, we're doing this video because tax brackets matter. Right? You need to know what these rates are because the more you pay in taxes, the less you get to keep. And so when we're doing tax planning, we want to look at the rates and we want to think about paying less tax over the life of this money, not just in any individual year, but these matter. So you need to know how they work, where you are, and what are some planning things you can do around those. So let me bring up the show notes. We have the board. You can find this at the link below our video. It's also on our website at cardinalguide.com. We have the board as always, and we'll get back into this. We did include a chart of the 2025 rates so you can compare them back and forth. We're going to spend most of the time on the new ones, the ones that are coming up for 2026. But if you want to go back and compare them, we have the 2025 rates in here. So take a look at them if you want. But most of the time we're going to spend on here and just really talking about what the new rates are, what are some planning strategies around them, and just what you need to consider. So I'll turn it back to Hans here.
Okay, so, Tom says they matter. Why do they matter? Well, we could start with Roth conversions. So, yeah, and that's not the only thing we're talking about today, but if you're 65 years old and we're doing tax planning for you, or we're doing a comprehensive financial plan, and part of that is tax planning, we're going to look at 2026, 2027, 28, 29. We're going to go all the way to until 2040, 2045. I mean, it gets question of the accuracy and what tax policy will be, more than 5, 8, 10 years out, but we're still going to plan for it based on what we know. And we're not just looking at the here and now. I mean, the here and now is important. So we're going to look. And so if we go specifically to Roth conversions, if we have a married couple, married filing jointly, around $400,000 is the top of the 24% bracket. So why do we need to know that? Well, very simply, 24% is an awesome federal tax rate. I mean, it just, if many of you paid taxes back in the 1980s and the 1990s, and, we had rates up, in the 40s and the 50% marginal brackets. So, you look at that and you look at the opportunity to pay taxes at 24% on that big of a number. It's certainly something we ought to take a look at. I'm not telling all of you to go out and start doing Roth conversions up to that number, but when you're retired, you have a little more control over your annual income than you had, or your annual taxable income than you had when you were working. Because when you were working, you just had money come in and you wait till the end of the year and you got your W-2. And if you had income from investments, but most of you had your investments in an IRA, so there was no taxable income coming from those. But if you have other investments, other businesses, that kind of thing, but that's just coming at you. You don't really have control in the end of the year. You can mess with that. You just were stuck wherever you were. And when we're doing financial planning, tax planning for you in retirement, we're going to look ahead several years, perhaps even to the end of your life, and kind of see what, if this is left to your spouse, and your spouse is then a widow, then the spouse is a single taxpayer, and they're going to move from that chart to this chart. So I don't want to go through and do the whole video in the introduction, but this stuff matters. And to be able to sit down during the year and decide how much money are we going to pull from the IRA and create taxable income to take advantage of tax rates, that matters. So, and as a single person, that number at the top of the 24% tax bracket is a little over 200,000. And for that reason, when we have a single person that has a very large IRA, a lot of times we're going to the top of the 32% bracket, and it gives us an opportunity to convert another 50,000. And again, we're not recommending this to everybody. We're just looking at this stuff and deciding what level of tax is acceptable. So I want Tom to speak on just the brackets a little bit, married and single.
Yeah, I mean, when you look at them, clearly there's a pretty big jump from 24 to 32. So you go from 22 to 24, and again, these are marginal brackets. I think it's always helpful just to talk through that. Not everyone understands this. Is your money, you get to fill up those lower brackets as you're earning money. So if you get to the 24% bracket, that doesn't mean that all of your dollars are taxed at 24%, right? If I'm looking at a single tax filer, the first 12,000 is taxed at 10%. The next, amount up to 50,000 is 12%. So you get to fill up those lower brackets. And so that's a common misconception that I see people make. But when you're going from 22 to 24, that's only 2% higher on that next dollar that you're earning, which is really not that bad. And so that's why oftentimes we talk about this. I do want to point out that this is very specific to each individual person, each person's situation. Like if you have sort of a moderate amount in your 401k, maybe you can just stay at the 22%, or even the 12%, right? It really just depends on how much you have. But if you have sizable IRAs or 401k, if you have a lot of money that's left in these accounts that haven't been taxed, you really need to start thinking about how to get this money out in the most tax efficient way. Because like I said, the whole idea of tax planning is trying to get these dollars out of those accounts, the IRAs, the 401ks, money that hasn't been taxed yet, at the lowest tax rate over the life of that money. And a lot of times we're doing that by Roth conversions, which means paying more taxes in this year, the year you're doing the Roth conversion, than you otherwise would have to. So sometimes that's a hurdle that you have to get over. But when we start looking at over the life of the money, I mean, I don't think we're going to ever have rates, or in the foreseeable future, rates that are lower than what we have now, right? I mean, 24%, having for a married couple, 400,000, just over 400,000, and being in the 24% tax bracket is great. Will they go up in the future? Maybe, maybe not. I mean, in the one big beautiful bill that Trump signed, that's reflected in these rates we have on the board. And really, you'll notice from 25 to 26, the 2025 to 2026 rates, the percentages have stayed the same. The brackets have increased a little bit. But that's a big change that was passed in that bill, because without that bill, these would have gone way up. And so we're not having to deal with that, which is great. But you need to consider doing this. And some of the common pushback we get is, well, I don't want to pull money out now because I don't want to pay things like IRMAA, and we'll talk about that in a second. And another one is there's this extra senior deduction that's included for people who are 65 and older. They don't want to lose that, which again, we don't want to ignore those things. But sometimes you're focused on the wrong thing, because if you have a couple $1 million in your IRA, or even $1 million in your IRA, and you're a married couple, you have to think about what happens when the first one passes away. Now we're having to file taxes at the surviving spouse is filing taxes at that single rate. You can just compare those two side by side, much less favorable. The RMDs really haven't changed, because when the first spouse passes away, the balance doesn't decrease. So now we're having to take essentially the same money out of the IRA, because you're over, at this point, presumably over 73 or 75, depending on your age. You're having to take money out from RMDs, and now we're jumped into the single tax brackets. That could be a real problem. So, you might wake up, years down the road and start kicking yourself, man, I should have been taking money out more aggressively now, because now I'm looking at the single tax rates, and I'm forced to be in the 32, 35% just based off the size of our IRAs, where I could have gotten money out at the 24%. So I just want you to consider it. Again, we're not saying everyone should do it at those rates, but if you have money in the IRAs and the 401ks and you haven't pulled money out, or you don't have a plan on how to pull the money out, you really should talk to us or somebody like us, where we can really help you come up with a strategy to get this money out. And maybe it's not Roth conversion. Maybe it's just spending it, right? Pulling more money out, raising your standard of living, taking trips, doing stuff that you want to do, right? It doesn't always need to be about doing Roth conversions, but getting money out of the IRA, I think, having a plan around that would be wise.
Yeah. So let's talk about the standard deduction, the changes that were made in that. So in 2026, married filing joint, the standard deduction is going to be $32,200 for any married couple, regardless of age. And then it's going to be $3,200 added to that, or a total of $35,400 that you can just put on your tax return as your deductions without even having them or adding them up or anything else. So you really can take this number and add it to this number, because you're going to pay taxes on the net income, the net taxable income. So this is a real big deal, and it's been around since 2018 that it's been the increased amount. In addition to that, a married couple filing jointly that's 65 plus is going to get a $6,000 additional deduction, like a standard deduction each, or $12,000 more. So that's going to raise this number to like $47,000 that you get to take right off of your taxes. And people say, wow, that's great. Well, there's a catch, is if your income is over $150,000, married filing jointly, you start losing this extra $12,000 deduction. So people say, boy, I don't want to do that. I got to keep it at 149.9 or less, because I don't want to lose that $6,000. You know, it's kind of like me reading about that in the legislation that got passed back in July. I'm all excited about that until I read that $150,000 income max. So it's like I had it for about 15 minutes and then I lost it. So, you know, you look at this thing, but what Tom's going to show you with an example is, don't get into one of these deductions or one of these tax advantages and then start making all your decisions around that, because I could go further. I could tell you that IRMAA, which is under Medicare, has a threshold for the married filing joint of 206. For the single people, it's 103. So, you know, people that tend to follow us, or that maybe this is the first time you're hearing about IRMAA, if you're turning 65 and going on Medicare, if you get over 103,000 single, or you get over 206,000 married, you're going to pay an extra tax on your Medicare. And if you get up there pretty high, you know, like the 400,000 or the 300,000, that IRMAA keeps going up and up and up. It becomes significant. And a lot of people look at that and then they stop doing any tax planning, and they, well, I don't recognize the income, I don't want to pay IRMAA. And we're with you on that. We're looking at it. But all these things are mixing together, and sometimes the benefits of doing one thing, it's more beneficial to give up some of these other things. I want Tom to speak about that for a minute.
Yeah, so let's talk about this extra senior deduction. And again, this was introduced in that one big beautiful bill that was signed earlier this year. Is if you're over 65, like Hans mentioned, you get an additional $6,000 deduction if your income is below these thresholds, and that's per person. One other key point on that is if you're itemizing deductions. So let's say you're giving a lot away to charity, or you have home mortgage interest, or different deductions that you're taking. You also get to take this on top of the itemized deductions too. So that's a little bit different than the standard or itemized, but that's sort of a small point. But so we get to a situation where you're looking at this and you say, man, I really like that. Or if we're looking at a married couple, that's another $12,000 deduction to go on top of our standard deduction, which sounds great, right? I mean, I think all else being equal, you're paying less taxes, which is really helpful. Now, what I've seen some people do is then go to the conclusion is, well, I'm not going to do any Roth conversions because I don't want to lose this extra senior deduction, which may be the right call and it might not be. And so to give you an example, so let's say you have somebody with a very large IRA and they've decided not to do any Roth conversion. Maybe they don't want to go to the 24% bracket because, again, that would crowd them out of being able to take advantage of that deduction. And again, I understand how you get there. But now you're losing out on that dollars that could have been in the Roth that are growing tax-free for the rest of your life, and then eventually gets passed on to your beneficiaries tax-free. And so one of the ways I want to think about this is if we look at that $150,000 limit and we look back up at the brackets, that puts you right in sort of the 22% bracket. So what you're essentially saying is, I don't want to increase past that. I don't want to pay money on this so I can get an additional $12,000 deduction, again, on a married couple. And so if we think about what a deduction is it's lowering your taxable income. So you're not having to pay taxes on that. So you're saving those tax dollars. So if I take the $12,000 deduction that you would have been getting, and I multiply it by 22%. So that's the tax bracket you're in that you would be saving dollars on. That comes out to a tax savings for a married couple of $2,640. $2,640 is the tax savings. So it's 12,000 times 22%. For a single tax filer, just cut that number in half. It's 1320 is the number. And so again, what you're doing is you're saving $2,600 for a married couple on tax savings, which is not nothing, right? That's helpful. But then the question is the benefit of the Roth conversion over the life of that money more than the tax savings you had in that given year? And I'd say probably the answer is yes, right? I think that it likely would be, especially if you have large IRAs. And so, again, all of this stuff is mixed together, and this isn't just blanket advice for everybody. So I'm not saying ignore it. Some people who are right on that threshold, yeah, we might want to stay below that number to take advantage of that deduction. Same thing with IRMAA, right? IRMAA has these thresholds. We don't want to ever make decisions solely based off IRMAA alone, right? So let's say I don't want to pay any IRMAA, so I'm not going to convert any more and just stay below the IRMAA threshold, which might be the right call for you. It might not be. For people who have large IRAs, you have an IRMAA problem, right? It's whether you want to pay it now or you want to pay it later, right? If we don't do it now, and that IRA continues to grow, you're likely going to get to 73 or 75 when your RMDs start, and that's going to push you into the IRMAA brackets anyways. And so the question is, well, if I'm going to have to pay at some point, why don't I go ahead and just accept some level of IRMAA now, be more in control of it, and get some money out of those accounts? So again, all of this is connected. It all needs to be individualized for you specifically. So this is not blanket advice for everybody. And that's what we sit down and do with people is we sit down, we look at sort of their income, what their income needs are, like how much do they want to spend. We look at their account balances and we project this out. We say, what is the sweet spot to get money out of these accounts to have the lowest lifetime tax bill for all of the money, as opposed to just looking at one individual year like 2025 or 2026. So again, I think it's helpful to consider what is the tax savings by making some of these decisions. Sometimes the benefit of the Roth conversion outweighs the tax savings you get by lessening the amount you're converting.
So we have a example, some people we're just dealing with now and we've been dealing with for several years, where they've been doing Roth conversions, but we just sat down with them and we showed them, this guy is 68 years old, so he's 5 years away from RMDs. He has quite a large, several $1 million in his IRA. And we showed him, despite the Roth conversions we've already done, if he keeps doing them, his minimum distribution is projected to be $320,000 in his 73rd year. If he doesn't do the Roth conversions, his RMD is projected to be over $400,000. So he's sitting here looking at that and he's saying somewhere between 320 and 400. I don't like either one of those numbers. I'm going to have a big tax bill. I'm going to have a big IRMAA bill. I can't even think about getting this thing no matter what I do. So, and then what pushed him over the edge of doing even more was one of them passes away. This is a couple. They go from here to here. And so all of a sudden you got that $400,000. He's in the 35% bracket. If this is all, or the survivor is in that 35 paying the widow's tax. And the widow's IRMAA is off the charts. So this stuff, when you start looking at it over 10 and 20 years, I mean, a person can just not do any planning and just kind of take what they get, do it ad hoc. You're going to make it to 80, both of you, or if you're single, financially. If you live that long, and you probably will, and you live that long, your money's going to be fine, unless you just went out and bought yachts or something, did something crazy, went to Vegas. I mean, you're going to make it to 80. The problem is that we're doing the planning is we're thinking about your 80s and your 90s, and that may just be one of you, and you're going to be over here. But we're also just thinking about the need for money and what kind of money you need and how much money you need in those years and how long you're going to live. That's where the planning really pays off, is making sure that when we get in our later years, whether there's one of us or two of us, we got enough money to live like we want to live, take care of the grandkids, and still possibly leave something to the next generation. So, Tom?
Yeah, I mean, I think like Hans mentioned, when we're doing tax planning, we really want to think about sort of the tax bill over the life of this money, and that might mean looking at the inheritance to your kids or your beneficiaries. And because a lot of times, if you have sizable money in the 401k, you're probably not going to spend through all of it. There's going to be money left to go to them. So some people say, well, I don't want to do any Roth conversion. I don't want to pay the taxes. My kids can just deal with it when they get it and they'll pay the taxes. And I really sort of question that. It's like, okay, you spent your whole life avoiding these taxes, doing a great job of sort of keeping these low, just to leave it to them where they pull it all out and go to the top brackets because they're likely going to be in their highest earning years when they're getting this money. That doesn't seem like a great plan. And so if we're going to leave it to them, let's think how to leave this to them in the best way. And if we don't care about them, then let's go ahead and just spend more of it, right? Why don't you enjoy it more? You worked hard to save it. If we're not worried about leaving it to them, then you spend it. I want you to enjoy some of it. So again, at the end of the day, the whole idea with tax planning is keeping that tax bill, the lifetime tax bill, the lowest possible, getting them out at the lowest rates we can. And that 22, 24% rate are really attractive. When we look historically what rates have been, these are great rates that you can have a lot of income and still be in pretty low income rate or tax bracket rates. And so I think it's certainly worth considering. Again, not saying everyone should do it, but I think it would be worth thinking about it if you haven't considered it before.
Okay. When you talk in terms of comprehensive planning, the whole video has been about taxes and tax brackets. We talked about estate planning and the widow's tax, the survivor of a married couple going to single taxpayer rates, and then having a very large taxable RMD. And by the way, the cap for this senior deduction earnings cap is 75,000 is where it starts phasing out instead of 150. Estate planning, we talked about income because that's what all this is about, is your taxable income and your spendable income in a given year. This has been a lot about 401k, IRA, and Roth conversions. We haven't really talked about long-term care. We talked about IRMAA and Medicare, and then we didn't mention, but your level of income drives the income taxes on your Social Security. So we really covered all of that. So I'd like to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.